securities are sold for the first time, and the IPO stands for initial public offering. For 2.15, money markets are the markets in which short-term debt instruments with maturities of less than 1 year are bought and sold. And capital markets are markets in which equity securities and debt instruments with maturities of more than 1 year are bought and sold.
Okay, and I'll go back and reinforce some of this stuff too, but we have to get going. So when you're presenting the actual problems, thank you very much. So when you present the actual problems, make sure you point at the numbers so you're guiding us through. Walk us through the solution, okay? So who has 3.9? 3.9? Okay, who has 3.5? Do you have 3.5 or 3.9?
No.
Okay. And could you speak up? Speak really loud.
3.9 says, during 2014, Towson Recording Company increased its investment in marketable securities by $36,845. They funded fixed asset acquisitions of $109,450.
And make sure you point those out on the Perfect.
And had
Yep.
marketable securities of $14,215 mature. What is the net cash used in investing activities?
So the 36,845 and the 109,455, those are all like investment money that the company is investing in other assets. So that's like when you look at a cash flow, it's like the cash is going out. So those are actually negatives. So it's a net like 146,300 of like a subtraction of cash going out, and then the 14,215, that's cash coming in from investment, like the return on their previous investments. So that's the positive. So you subtract the investing activities from the money coming in. That's your net cash flow.
Okay, and then was there a financing activities portion to that problem?
It's
No?
just this, yeah.
Okay, okay, cool. Thank you. Okay, and who has a 3.5? Great, thank you.
All right, so
Do you have 3.7 and 3.5?
yeah, we have 3.5.
Okay, awesome, thank you.
So 3.5 was just about working capital, like what's the company's net working capital, and net working capital is just current assets minus current liabilities, and these are all the current assets: cash, accounts receivable, other current assets, and inventory. And all the current liabilities were short-term notes payable and accounts payable. So we added these up, and then we subtracted by the liabilities, and the net working capital is $6,655,610. And the 3.7 is write an income statement for a company, and an income statement is basically revenues minus expenses, and that's the net income before taxes. So we had the sales, we subtract all the expenses, and then the net income before taxes was $372,925, and then we add the 35% tax to it. So we multiply the net income before taxes with the 35% taxes, and that was $130,523.75. So the actual net income for the company was $242,401.25.
So if your net working capital is shrinking significantly, what do you do? So you're running your business and your net working capital is shrinking. What do you do? You're going to be in trouble at some point, right? You use net working capital to finance your inventory and stuff. So what happens when your working capital starts to shrink? What do you do? Exactly. You have a line of credit with a bank or multiple lines to be able to bridge that. Excellent. And then remember in the stock worksheet, I had revenues as the scaling factor to come up with the weights for the portfolio. Could I use sales for the different companies instead of revenues? Yeah. Could I use EBIT, earnings before interest and taxes? Could I use that? Yep. Could I use EBITDA? Earnings before interest, taxes, depreciation, and amortization. Could I use that? Yep. Could I use net income? Could I use net income as the scaling factor? Yep. Okay. Thank you.
So we
did 4.9. It was asking for the ROE, and it gave us these numbers. So asset turnover of 2.1, net profit margin of 7.5, and equity multiplier of 1.9. And to find the ROE, all you have to do is multiply these three through, and it came out to 0.29925, which is 29.93%.
If I'm an investor, do I care about return on equity? Yep, it's really important. Okay.
Okay, and 3.10 was asking what the role of the statement of cash flows is. So basically, the statement of cash flows records both the cash inflows and outflows for a period of time, and it allows us to report the changes in the cash position of the firm between successive accounting periods.
Okay, and did you do the bottom one?
No, that's
Okay. Another question. If I was going to build a regression model to try to forecast return on equity, could my independent variables be asset turnover, net profit margin, and equity multiplier? Could those be the independent variables? Could I build a forecast model to forecast return on equity using asset turnover, net profit margin, and equity multiplier as the independent variables? Yes, excellent, thank you.
So my calculator, for some reason, was rounding up, so I got the wrong answers.
Well, how close were you?
3% off.
Yeah, sometimes the rounding errors are gonna,
Yeah.
but if you use the correct methodology, I wouldn't get too hung up on it.
So
Just as long as there's not, it should be negative and you got a positive, or it should be positive and you got a negative. If it's close, I'm not gonna worry about it.
yeah. So my ROA, I ended up with 10%, and the ROE, I ended up with 23%.
I think that might, did you check the?
Yeah, it's 8% and 20%.
That's pretty close. You might want to just go back and check it.
Yeah, I figured out what was going on, which was my calculator was rounding up.
Okay,
So
okay.
anyway, ROA.
Go out, you want to go out at least 2 decimal points.
It's only going out. Well, yeah, it's 2 decimal places.
Okay, okay.
Anyway,
Try-
ROA is net profit margin times total asset turnover, and ROE is the ROA times equity multiplier. So, net profit margin, first you need to get the net profit margin, total asset turnover, and then the equity multiplier. To get the net profit margin, you just multiply the net income with the net sales. Total asset turnover, you multiply the net sales with total assets.
Is it multiply or divide?
Or divide, actually. You divide net sales with total assets, and then equity multiplier, you divide total assets with total equity.
Okay, and can you write that in too?
Yeah.
Okay,
And once you got these numbers, you should be able to do the calculations.
okay, then, yeah, just double check. Okay, I mean, later on, just double check the numbers, okay? Because we need to move on. All right? Do you have 2 problems, or is that the only one?
Yeah.
Okay. Okay, that's good.
So we had 2.4 and 2.6. So 2.4 asked about what are the 3 forms of the efficient market hypothesis. And so the first one is strong form efficiency. So basically what that means is that all the information that we need is reflected in the price of a security. Then there's semi-strong. That's all public info. So that's all the info that's available to investors is reflecting the security price. And then there's weak form, which is that all info from past prices are reflected security price, but no info from the present or future can be found from the info. Then 2.6 asks about the relationship between interest rates and the business cycle. And basically we found that interest rates follow the business cycle. So when the cycle enters an expansion stage, interest rates go up, and if it enters contraction stage, interest rates go down.
That's great. And then the efficient market hypothesis under the strong, semi-strong, and the weak form basically states that you can't make any money by using inside information, financial information, or charts of the past. But we all know that you can make money on inside information. We can make money and value the stock using accounting information, and we can use technical analysis to be able to trade securities and make money using technical analysis. So even though we assume efficient markets and the hypotheses, we know the violation, that they can be violated too. Thank you very much.
So we had question 1.19 and 1.25. So 119 asks, what are the factors that affect stock price? And those are the characteristics of the firm, the economy, economic shocks, the business environment, expected cash flows, and current market conditions.
And then 1.25 asks about information asymmetry, and it exists when a party in a transaction has info that is not available to the other party in the transaction. Parties with less info will pay less for the goods or charge more for what they sell.
If I was going to build a regression model to forecast the stock prices, could I use those factors as the factors in my regression model? Yep, got it. Excellent, thank you. You need a double applause.
All right, well, so we did 3.13 and 3.14, and 3.13 looked at the cash flow invested in net working capital for a company in 2014.
Thank you.
And to use that, it gave the assets and liabilities for 2014 and 2013. So you use the first substitute for the assets for 2014 minus the liabilities for 2014, and then the assets for 2013 minus the liabilities for that year. And then using that, you come up with your cash flow invested in net working capital.
Great, thank you.
And then 3.14 is dealing with long-term assets before depreciation. So at the end of 2013 or beginning of the year, so December 31st, 2013, long-term assets before depreciation was 990,560. And then at the end of 2014, December 31st, 2014, long-term assets before depreciation was 1,211,105. So to get the cash flow invested in long-term assets during the year of 2014, you just take n minus the beginning, and you end up with 220,545.
Great, thank you. So who has that 419?
Which then equals 1 over 1 minus 0.56, which was given. So then we ended up with 2.27, and then we plug it into the debt ratio, which is equity multiplier, minus 1, which is 2.27, minus 1, which is 1.27.
So that's the debt ratio? Is the firm over levered at 1.27? Does it have a lot of debt? Well, it has some, a lot, but what if it was 2 or 3 or 4? Yeah, then it would be really over levered. It would be a lot riskier, and the stock price would be more volatile. That's probably pretty conservative, okay? Because you want to leverage your assets so that you can increase your return on equity, okay? Thank you.
And then I also had 5.1, which was to find the interest rate on a $25,000 investment for 10 years with 8%. There's actually an equation for this, which is future value times 1 plus interest to the root of the years you're investing in. So basically it's 25,000 times 1 plus 8% to the power of 10 years, which you get 53,970.
Is the 25K the future value or the present value?
Oh, present value.
Thank you. And then if I was to, these are compounded on an annual basis over 10 years. What if we were to compound it on a quarterly basis? How would we adjust it?
You would do 4 to, I think you would do 4 over...
4 times 10?
Yes.
And then what would you do with the interest rate?
divide this by 4.
Excellent.
So I had a 2.24, and it basically asked what the 2 risk hedging instruments mentioned in Chapter 2 were, and those were future contracts and options contracts.
And what other contract would you use to hedge if you think prices are going to go down?
Forward.
Excellent. Nice job.
I had 3.10, but I have the question, not the discussion question. So the question was, cost of chemicals management identified the following cash flows as significant in its year meeting with analysts. During the year of costing, we paid existing debt of $312,000, which is this, and raised additional debt capital of $650,000, and also repurchased stock in the open market for a total of $45,250. And then it is wondering what is the net cash provided by financing activities. So all I did was take $650,000, $650,000 because that's what you raised. Subtract $312,000 from it, and then subtract another $45,250 from it, and you get $292,000.
Okay, so this is where we've raised our money.
Yeah.
Yep. Okay, who's got 4.1?
We got that.
Okay, thank you. Oh, nice job.
So 4.1, the quick ratio is a better measure of firm's liquidity than the current ratio, since the quick ratio subtracts inventories from assets, being that inventories is least liquid of all assets. So the quick ratio just represents more liquid assets. That it takes the assets that don't have as much liquidity out of the total assets.
Alright, mine is 4.6. So 4.6 asked or gave us the total assets and debt ratio, and it asked us to find the debt to equity ratio and equity multiplier. So first you start out with the total debt ratio equation, which equals total debt divided by total assets. That's basically the overarching theme. And then you go to total debt, which equals total debt revenue times the total assets, which is, in this case, the total debt revenue was 29.5%. So 0.295 times the total assets, which was $422,235,811. So the total debt would be $124,559,564.20. Then next, you find the total assets, or you have the total assets equation, which you can rearrange to be total equity equals total assets minus total debt, which is what we used. And then we got $422 million, which is the total assets, minus the total debt, which we got from up here, which is the $124 million, and the total equity would end up being $297,676,246.80. Then now we can get to the debt to equity ratio, which is the total debt, which we got up here. Minus.
And can you stand to the side?
Yeah.
Okay, perfect. Thank you. That's okay.
Where was it? Oh yeah, the debt to equity ratio. So you take the total debt from what you got up here, divide the total equity, which is the $297 million, and that will give you 0.42. And instead of put it in decimal places like that, I don't know if like you want a percentage at all.
It's 42%.
Yeah.
Okay.
So the debt to equity ratio would be 0.42. Then you want to find the equity multiplier, which is total assets divided by total equity. So you just take the total assets, which was given, and divide the total equity, which you got right here, and you will end up getting an equity multiplier of 1.42.
Now in 4.19, the debt to equity was 1.27. Over here, the debt to equity ratio is 0.42. Which company is more conservatively leveraged? Got it. Thank you.
Okay, so for 5.9, it says Roy Gross is considering an investment that pays 7.6% compounded
If the interest rate goes up, does the present value go up or down? If the interest rate goes up to if it goes from 0.076 to 0.086, does the present value go up or down? Excellent. And if the interest rate goes down? If the interest rate goes down, the present value goes? Nice. Excellent.
Okay, so this is 5.8, and Joe is expected to hit 15 home runs in 2014, and that rate is expected to grow 12% every year for the next 5 years. So how many home runs will he hit in 2019? So the future value equals the present value times 1 plus the interest rate to the amount of years. So he's expected to hit 15 home runs in the present time, plus the growing 12%, so 0.12, and for 5 years, so 26.43512. So Joe's expected to hit about 26.44 home runs in 2019. Okay, so 5.12, so this girl wants to buy a house in 5 years. She believes she's going to have to put down a $35,000 deposit, and she invested in that 9.25% annually. And so I use the present value equals future value times 1 over 1 plus interest to the number. That's how I remember it. And so 35,000 is the future value, and then I did the interest here and then to the fifth because 5 years, and then the answer I got was 22,489.24.
Great, thank you. So take pictures of these, and then we'll probably do, and then if somebody could note the ones that we did today and which ones still need to be done, then we can pound those out. Next week too, we'll do the quiz, and then we should be in really good shape going into the quiz period. Okay. Sign up to see me. If you want to see me.